So while Alex is fixing his connectivity, let me just start introducing the session. The starting point is a paper that Alex Lehmann and I produced for the European Parliament like 2 months ago on tailoring prudential policy for the needs of taking into account the size of banks. So that's something that Europeans generally refer to as proportionality in prudential regulations. And the key word in US practice is tailoring. The reason we use this word tailoring being that proportionality, of course, in the European context also refers to a treaty principle, which means something slightly different about the fact that measures in European law should be proportionate and not excessive, but without specific reference to banking or bank size. With that, I will give it over to our different panelists, and we start with the representative of the European Central Bank. I'm sorry because I have to apologize. I don't have my notes with me here, and I wasn't prepared for that role. So I'm not going to introduce you with all the biographical elements in the temporary absence of Alex, but you have the floor.
Thanks a lot, Nicola. So my name is Anne Fröhling from the European Central Bank. I'm the head of division for the LSI oversight activities within the supervisory arm of the European Central Bank. And thanks a lot for having me here to talk about proportionality, which is basically my daily bread and butter business. And maybe a quick caveat at the beginning, I will talk mainly about how we implement proportionality in our daily supervision. Of course, there's also a regulatory element where legislators have made up their minds in Europe how they want to tackle proportionality in the regulatory framework. There have also been some recent developments here. I will mention that as well, but all in all, it's really about how we as supervisors within the ECB and within the single supervisory mechanism more broadly use proportionality and work proportionate with larger and smaller banks. So a quick background on the single supervisory mechanism. We started the work and took over the supervision of a large part of the Euro area banking market in 2014. At this stage, we are covering 21 member states. So this is the Euro area member states. And as of last year, we had Croatia and Bulgaria joining in the context of close cooperation ahead of their anticipated entrance into the Euro area in the next couple of years. The single supervisory mechanism in itself, I think, has a large degree of proportionality built in by the fact that the European Central Bank supervises significant institutions, while the national competent authorities in the 21 countries supervise the less significant institutions. The significant institutions, that's currently around 115 banks that are supervised directly by the ECB, make up around 80% of total assets in the markets I mentioned. On the other hand, the less significant institutions make up the rest of the market, so about 20%, a bit less actually, but consist of about 2,300 institutions, LSI. So quite a large number. These are actually largely focused in 2 countries. Germany and Austria have the largest amount of less significant institutions. So as already mentioned, I think this pure differentiation between direct supervision of significant institutions and indirect supervision or oversight that we have for less significant institutions, and thus national competent authorities supervise these less significant institutions. This already brings the first layer of proportionality. And maybe to give you a very simple proxy of what that means in practice on how we supervise in practice, I think a simple proxy is, for instance, if you look at how many supervisors are actually supervising a single institution. And for significant institutions on the ECB side, we're probably looking something in the range of a very high single-digit number of FTEs looking at one institution. And that would actually then be accompanied also by additional supervisors in the NCA. So we're definitely looking on average at something north of 10 FTE per bank on average for significant institutions. If you look at less significant institutions, the average FTE supervisors hold for them is below 1 FTE, encompassing both offsite and onsite activities, you already see it's a quite significant difference between significant and less significant institutions. Then comes another layer, and I know that this chat is more about smaller banks, but I wanted to also maybe look a bit into the proportionality for SIs, because you have compared a lot in your paper, Nicola and Alex, also the US tailoring concept. And the US tailoring concept largely focuses on different categories, but all of these banks have total assets north of 50 billion US dollars. So in our European context, all of them would be significant, right, in these categories that the US is outlining. So this is why I think it's probably meaningful to also quickly look into how do we apply proportionality for significant institutions. And what we do here in practice is that we cluster them into 6 different clusters, size, complexity clusters. And those clusters, together with the risk dimension as well, actually define how much work and how intense we work with the different banks. We call that the minimum engagement level and the supervisory strategies. So that really determines how many on-site inspections you get, for instance, which is definitely a high driver of regulatory costs. I would say if you have to, as a bank, accommodate an on-site inspection team for a couple of months, this usually is quite a high effort. It also triggers the number of meetings, the intensity of certain analysis, the type and number of deep dives and thematic reviews, etc. So this is within the SI community, as mentioned. I think this is probably something that you're looking at very strongly when you compare it to the tailoring. So that's this first part. The layer of proportionality, then moving on to the less significant institutions. I mentioned before, it's 2,300 institutions in the SSM. It's a vast amount. What we do together with the other supervisors in the SSM is we do look at them in different buckets. So we are differentiating between high impact, less significant institutions. These are also published on our website. That's about 90 institutions at the moment. And these high impact LSIs will get a more intense supervision and oversight than other LSIs. For instance, they will have to run an annual SREP assessment. Just to give you an example, of course, the risk dimension plays in as well. So the NCAs would definitely differentiate their approach and their minimum engagement levels with the banks also by the risk dimension, very obvious. Now moving into, as I already mentioned, regulatory changes. So we have had a very recent introduction of a new regulatory concept of small and non-complex institutions in Europe that was included in the CRR2 CRD5 revision and implemented as of summer of this year. And this actually covers about 80% of less significant institutions in the euro area that would be considered SNCIs, this new concept, and they will have some notable improvements in terms of complexity, for instance, in the concept on the NSFR or IRBB approaches, also on disclosures, remuneration, and on top of it, EBA has been mandated to look into more facilitation in terms of reporting. The EBA published in July their paper and recommendations of how the reporting for SNCIs could be made simpler. The implementation will take a while. If you look at all the recommendations, they are partially quite extensive. So I think there is going to be quite a number of things coming in, and for those institutions being classified as SNCIs. As ECB, we strongly supported this concept and do support this differentiation. For making the framework simpler for smaller banks. We also welcome possible inequalities that might be removed from the implementation of Basel III, so specifically also on the use of standard approach versus internal models, which clearly is giving advantages to larger banks when it comes to capital requirements. What we do not support, however, is less frequent reporting or also dropping the reporting of important, significant supervisory data points. The background is simple. We do believe that even smaller banks pose and can pose a risk to the system. And we need, as a supervisor, we need to be able to continuously act in a forward-looking manner to identify and act on crisis cases early enough. And Nicola and Alexandra, I'm sure you're also going to go into the whole resolution framework and comparison. I think that plays a big role here. Maybe just to undermine the fact that small banks can pose quite notable risks to the system as a whole. We had recent cases in different member states over the last 2 years where a single institution that actually fell below the 5 billion threshold, which the SNCI definition encompasses, institutions have wiped out, failing institutions, even small ones, have wiped out the national deposit guarantee scheme ex-ante funds, meaning a lot of burden for the other members of that. So a lot of banks needing to pay large extra contributions, which is something that surely in the future we don't want to see so often, and that would destabilize the system. So to summarize, we are a big fan of proportionality as long as it's not at the expense of the safety of institutions and at the expense of getting regular and appropriate information as supervisors. And with that, I would close it here and happy to respond to questions later on.
Okay, thanks so much, Anne. I'm back online. Apologies for the slight hiccup earlier. So let me hand straight over to Nicholas to compare the Euro area context to the US situation, including based on the paper we both published.
Exactly, and thank you, Alex, for giving me the opportunity to present our joint paper. As you mentioned, this was presented to the European Parliament at the request of the Econ Committee in October, tailoring prudential policy to bank size. And my brief remarks here will be entirely based on that paper. As you can see, I am at Bruegel in person. It's a very nice feeling to be back in the office for this organization, even so I'm alone in the room, which of course is a more mixed experience. Our paper is descriptive. We didn't have the time, given the allocated timeline of the European Parliament Econ Committee, to enter into a very heavy-duty analysis that would have allowed us to ground policy recommendations on that kind of analysis. So what we did is we just described the differences between the policy framework in terms of taking account of bank size between the US and the EU. And we also added another descriptive section, which is just how important small banks are in the broader system in comparison between the US and the EU. And I will look at those 2 points very briefly in my remarks. The first is the policy framework. I don't think it can be said in a general way that the US framework is more proportional or with more differentiation between smaller and larger banks than the EU one, or indeed the other way around. It really depends on what you look at in the framework. So if you look at licensing, which in the US is called chartering because the banks are chartered institutions, which is a slightly different concept legally from the European situation where the banks are just commercial entities which get a license to provide banking services. The framework here is more differentiated in the US, not necessarily by size, but with this principle that there are state-chartered banks and nationally or federally chartered banks. And the same is true for a separate segment, which is almost non-existent in the EU, but is more significant in the US, which is credit unions. So retail credit institutions, which are not considered banks under the legal framework, even so their business is not that different from small retail banks. So I will keep referring to banks and credit unions in the US because we really wanted to look at them together in order to compare apples to apples. And there are also state-chartered credit unions and nationally chartered or federally chartered credit unions. Now, if you look at this in more detail, we notice that there is not really a size component to this, except for the larger banks. There is no average size difference between, for example, nationally chartered banks or credit unions under a certain threshold and federally chartered ones. So actually, it's not the case that in a specific size category, the state chartered ones are smaller than the nationally chartered ones. In Europe, of course, we have a single system of licensing, which in that respect is more centralized than in the US, because everybody is licensed by the ECB, even so a lot of the administrative treatment of the licensing process can be delegated by the ECB to the national competent authority. Now, if you look at supervision, instead of, well, first, maybe, if you look at regulation, so the prudential requirements as they are set up in the rules and legislation, but also very importantly in the US, rules issued by the different supervisory agencies. So it's more delegation of rulemaking to the agencies in the US than in the equivalent EU system, where a lot goes back to the co-legislators, even for minute detail. Here, the US has more proportionality. It has more differentiation of the requirements between larger and smaller banks. And especially when it comes to the Basel process, the US doesn't have the principles that has been adopted so far in the EU, that the Basel standards defined at the international level only apply to the larger internationally active banks. So the EU applies Basel standards to all banks. The US only applies them, I'm not sure I said it right, to the larger internationally active ones. And that's a big difference. Now, conversely, the US is more compliant, as we know, with the Basel standards than is the EU. So it depends where exactly you put the bar. The EU has areas of material non-compliance with the Basel standards, which apply equally to the smaller and the larger banks. If you look at supervision, there is a more fragmented system in the US because you have a number of different supervisory agencies which partly overlap in terms of their turf. You have the Federal Deposit Insurance Corporation, which has backup supervision for all banks, but not for credit unions, and has primary federal supervisory authority for smaller, typically smaller banks, which are the ones chartered at the state level and not part of the Federal Reserve System. The Office of the Comptroller of the Currency, which is technically part of the Treasury Department, is the main federal supervisor for the federally chartered banks in general, but for the state chartered banks, which are part of the Fed system, it's the Federal Reserve Board and system, which is in charge of supervision, and also the Fed is in charge of the supervision of bank holding companies, so the entities at group level, which in the US are not banks themselves, they're not chartered as banks, but they're the parent entity of banking groups, which typically have other operations, such as broker-dealer and asset management. In Europe, conversely, these holding companies are typically supervised as banks and generally have actually a banking license, even so that's not the case in all significant institutions. So there is some differentiation here. What's interesting is crisis management. And here, the US is much more one-size-fits-all to a considerable extent than the EU. The EU has all these complicated and partly unpredictable differentiations depending on the so-called public interest test in the Bank Recovery and Resolution Directive, in which we have seen some variations of doctrine on what exactly constitutes public interest, which determines the procedure whether a bank goes into resolution as per the BRD or national normal insolvency proceedings as they are defined differently in each member state. And here we've seen variation of the public interest test, both geographically with Denmark and, for example, the UK applying different criteria than in the Eurozone, the Single Resolution Board. Generally, the Single Resolution Board has put the bar much higher in terms of how big a bank has to be or how significant it has to be to meet that public interest test. But also variation in terms of time sequence, because the doctrine of the Single Resolution Board as to how to define the public interest test and how to interpret it has appeared to vary over time. We have very few test cases in terms of actual decision, but when you look at the rhetoric of the Single Resolution Board, in the early years they were saying that, to quote Elke König, resolution was for the few, not for the many, and if I'm correct, this mantra is no longer the official position of the Single Resolution Board as to the more recent period. So this is just to say, I'll conclude here for the comparison of the policy frameworks, that it's just very different, because the US and the EU, and specifically the Eurozone on which we focused in the study, have different legacies, they have different stories, they have different banking structures, and it's very difficult to compare them term to term. There are lessons from the US to be learned in Europe, for sure, but you cannot directly transpose the US policy framework to an EU-centric analysis. Now, let me finish with our comparison of banking structures, because I think that's very important for the debate. And here the main takeaway is very simple. Especially if you add credit unions to the mix, which I think is necessary because they're really not very different from retail banks. The US has many more standalone small banks than the EU. So in the EU, we have surprisingly few standalone small banks. We don't have many credit unions. There are a few in Ireland, but even there, they're kind of negligible in the Irish banking system or financial system. But more importantly, what the ECB calls less significant institutions, LSIs, or actually what EU law calls LSIs, more than half of them are in what is also called in the jargon an institutional protection scheme. What is an IPS? It's a mutual protection arrangement, which means that if one of those banks is failing or likely to fail, it will actually be protected, rescued by the collective arrangement. And that's very important for financial stability, because that means that for financial stability purpose, these banks are not significant at an individual level because they help each other in case of a problem, but the actual set of all those banks in an institutional protection scheme can be very significant taken all together. And indeed, the biggest IPS, institutional protection scheme in the Eurozone, which is the German Sparkassenfinanzgruppe, is bigger than in total assets than any significant institution in the Eurozone. It's bigger than the biggest banks like BNP Paribas or Deutsche Bank or Santander. So basically, let me conclude here, and I leave you to the numbers as they are in the study. But the reality of the Eurozone is that the institutional protection schemes are significant. They should probably be considered in a consolidated or combined level in terms of financial stability analysis, and also in terms of compliance, because they have support services at the central level or federal level, whatever you want to describe them, which means that they can support some costs that a standalone small bank cannot. And if you look at the real standalone small banks, there are surprisingly few of them. And I think this is important in terms of how policymakers should consider this challenge. Thank you very much.
Okay, thanks so much, Nicholas. I mean, for me at least, that was a really interesting and revealing finding in our paper. So thanks for pointing this out. And I think it's also inform the policy debate. In the introduction, I wanted to give but couldn't. I wanted to mention the German coalition agreement, which in the introduction to the banking section mentions very prominently that they're very proud of the existing structure and will seek to preserve it. So I think this is certainly food for further debate, and we hope to get back to this in the Q&A. Just in case Nicholas didn't mention that, if you have a question to any of the panelists, please enter it on the website sli.do. Hashtag banks. Already see 2 questions, and I'm sure we'll have plenty more in the Q&A. Let me hand over to Phil Evans from the Bank of England. I think that's a very interesting story that's unfolding there as to how your treatment of smaller credit institutions is about to be revised. Phil.
Thank you, Alex, and thank you for having me along. So I have some slides. I'm going to try to share these now. Let's see. Does that work?
Yep, I see them. Yep.
Perfect. Okay. So look. So thank you very much for having me along, as I said. So I'm Phil Evans, Director of Banking Policy at the Bank of England. It's actually great to be back at Bruegel, actually, even if only virtually. So I was an advisor in the early part of my career to Sean Berrigan in DG ECFIN between 2012 and 2014. And so naturally, events at Bruegel became something to know and love during those 2 years. So I'm very pleased to be back. Thank you. So as Alex said, I'm here to talk you through some work that we've been doing on creating a strong and simple regime for banks in the UK. So this thing is intended to be what it says on the tin. It's intended to be strong and both strong and simple. Easy to say, much bigger job to do. So we are in the early phases of doing this work in what I think is probably likely to turn out to be a multi-year project. But what I can do today is tell you where we've got to so far in terms of our thinking. Okay, so in terms of an introduction, I mean the basic idea is that the PRA, so that's the microprudential supervisor that's part of the Bank of England, is beginning a piece of work that basically poses two meta questions. And so one is, can we imagine producing a new regime that maintains the resilience of smaller non-systemic banks and building societies, but in a simpler way? So it's basically strong and simple. Can we imagine a regime that is strong and simple for those firms? But two, can we do it in a way that is going to avoid increasing barriers to growth? So we in the PRA have a secondary objective to promote competition, so competition within the UK banking system. If all that we did was create a regime which was for small banks but trapped them in it so that they were unable to grow, then I think it would be hard to argue that we had promoted competition in the UK market. Now, all regimes have barriers to growth, of course they do, because they have thresholds in them. So you need to define a point at which something changes, and then you move over and take a different approach. And those thresholds are always going to create some kind of barriers to growth. But you don't want the marginal cost of moving over these thresholds to be so high that the marginal benefits of moving over them can never compensate. And if we were there in such a regime, then I think we'd say that we'd created too strong a barrier to growth, and we'd risk trapping small firms in it. And as a third bullet says here, I mean, we have no interest in doing this by weakening the level of resilience, hence the name strong as well as simple. As Nicola has already alluded to, I mean, the UK isn't the only jurisdiction that's gone down this road. I mean, in terms of rulemaking, I'd say the EU setup of largely the same rules across the market is probably more the exception than the rule, looking around the globe. Now, in terms of what we've done so far, what we've done is we put a discussion paper out in the earlier part of this year, and we're basically asking for feedback. So this discussion paper doesn't include our proposals yet. We haven't got that far. But instead, what we're doing is floating some of the key issues, seeking feedback from firms and interested parties, and then after that, we'll put proposals out. So what I can do today is talk to you about some of the thinking and issues that are contained in that discussion paper. So I'll start.
Phil, if you forward your slides, we still see the title.
I am forwarding my slides.
Okay.
Sorry. Can you see now? Is that better?
Yep.
Okay. So the sharing, I think the problem is going onto that mode where it's just the slide you're talking about. So I'm on this one, number 3. So I'm talking about the motivation for why we're doing all of this. It's essentially because we think that there is an unlevel playing field for small firms right now. And what we're doing is seeking to make it more level than it currently is. Why is that? Well, it's because of what we call in the discussion paper, the complexity problem. So this means that the fixed costs of understanding, interpreting, operationalizing prudential requirements are large in proportion to the benefits of operationalizing them for small firms. So more complex rules tend to accompany more complex activities, and small firms very often won't do any of these or much of these complex activities, and so complying with complex rules that are difficult to operationalize, that they don't use very often, is imposing a deadweight cost on them. That's the hypothesis. So we're basically doing two things. So we're basically thinking of trying to level the playing field for two reasons. One is because these high fixed costs mean high average costs for small firms. But second, some complex requirements just aren't very relevant for smaller and simple firms. Now, it's not just it's not just a sense of leveling the playing field. It's also that this complexity problem affects us in achieving our objectives. So I've already mentioned that it's negative for our secondary competition objective, which we're given by the government, but it's also negative for our primary safety and soundness objective as well. So, for example, if small bank profitability is continually squeezed because the dice are loaded against them, then it's going to detract from their safety and soundness. And if small firms artificially risk up to try and recover their profitability, that's also going to be a detriment to our primary objective of safety and soundness as well. All of which means that the requirements we do have for small firms could be basically simplified to reduce our average costs and to support resilience, both at the same time, rather than weakening it. For example, if we reduce the incentive to risk up that sometimes small firms face. But as I said, we need to do this in a way that doesn't increase barriers to growth. So, where are we looking to get to? And oops, sorry, slides have gone a bit off. Okay, there we go. So where are we looking to get to? How are we looking to get there? Christ. So this diagram is a bit of a simplification, but bear with me for a second. So a firm might start small and simple, and then may grow to become large and complex. At a certain point, up in the top right corner here, it's clear that Basel standards have to kick in for suitably large and complex international firms. Our plan with this work is basically to start in this bottom left corner. So we're going to focus on picking a regime for the smallest and simplest banks down here. Now, in between that regime for the smallest and most simple banks and up to Basel standards is likely to be a gap. And one of the questions that we posed in this discussion paper is whether there could and should be other layers in this gap in between. So the discussion paper we put out is pretty open about that. It invites feedback on whether, but the options are a more graduated approach, which is a bit like what the US has, or a kind of or a switching approach. You go from the one regime to a different regime, and there's kind of no graduation in between, without additional layers. That's more like the Swiss approach, and there are obviously trade-offs to think through there. In terms of some of the other issues that we get into in the paper, I mean, there are lots and lots of them, so I don't have time or scope to go through all of them. But this slide has a few of the kind of bigger, more broad brush ones. So one is, you can't do very much on this without fairly early on pinning down what the scope is. So which firms should be in the regime? And there are key choices we would need to make over geographical footprint, size, activities that should be allowed for firms to undertake, how risky the exposures could be. I mean, taking those in turn, something that's more domestic, smaller, simpler, less risky, look like the broad directions that we'd be thinking about heading in. On the requirements we put on firms in the regime, I mean, there's a high level design choice, and we basically describe two different types of high level approach. So one is a streamlined approach, what we call streamlined, and the other is focused. So imagine you had a book, a manual, say, a book, with lots of different chapters. In the streamlined approach, we'd keep all of the individual chapters, like capital, liquidity. We keep all the individual chapters, but we'd make each one of them shorter by shaving them off and making them simpler. But you still have all the same chapters that they currently have in the regulatory book. Whereas in the focused approach, what you do is consider removing some of the chapters in the book completely while beefing up the remaining chapters. So an example of this, I'm definitely not, I'm not saying we would do this, but an example of this, which some other regimes have done, is they've basically done away with risk-weighted asset approach, just kept leverage, but made the leverage minimum higher. So that would be an example of the focused approach. And then the third general issue is how to transition to get there. I'll skip over that given the time. So where do we stand now? The discussion paper's out there. It was intended to promote discussion. We've had a lot of responses. I mean, our plan is later this month to put out another paper which kind of just replays back what the feedback we've been getting is. So that will come this month. It won't have our proposals, but it will have what firms have been telling us. And then in light of that, we'll basically move on to the design. And I will stop there. Thank you very much for listening.
Thanks so much, Phil. Really interesting how your secondary mandate on competition shapes the prudential work. And I think, I mean, obviously this is also a concept in the euro area, the dynamism coupled with the resilience of the system. But let's bring in Xavier now. And I think the aspect we haven't really touched on is the structural challenges in the banking market, as you know, obviously the digital transition and the fintech challenge will bring smaller banks in particular under greater pressure. So I wonder whether you can sketch out these structural changes and maybe think through what that may mean for both regulation and supervision. Xavier. Sorry, we can't hear you yet. Can you unmute yourself, please?
Yes, sorry. I was saying I'm glad to be back at Bruegel, albeit virtually. And I'll try to briefly present some of the challenges from fintechs, which are typically small banks, although if we think about fintech technology, we should include the big tech platforms, and these are definitely not small. The largest banks are minions with respect to the large platforms. So I'll try to very briefly to talk a little bit about how fintech is making inroads, and then about competitive mechanism between these new entrants and incumbents, and if I have time to make some comments about regulation. So here, this is some work from the BIS, in which in different jurisdictions, they look at how lending by big tech and fintech, the fintech here are the small ones, the fintechs, is raising rapidly, but at different rates. So we see the red ones is big tech credit, which it's quite important in some jurisdictions, but not in some others. Like for example, the United Kingdom, where fintech takes over, or in Mexico, or in the United States, and you have France also with quite a bit of fintech. Also, the red dots, and this is the scale on the right, looks at total fintech credit per capita. So we see also quite a few differences. So in terms of credit, personal loans, mortgages, fintech is increasing. Obviously, this is not the main focus. The main focus still is payments, probably, okay? But I wanted to highlight credit here. And in fact, in the US, if we look at the non-bank share of US financial corporations' assets, we see that starting in 2012, etc., and so on, both in mortgages and personal loans, there is quite a bit of an increase in these non-bank shares, and fintechs are also a very big proportion of these non-bank shares. Okay, so this is it's an important development. What are the fintech advantages and disadvantages? Well, the advantage of fintech technology is that they have a superior technology, free of legacy systems, for example, of the mainframe. They can work directly in the cloud, linear operation, a friendly consumer interface with a newer standard of consumer experience. They can focus then on activities and business segments with higher returns, in a sense, a little bit clean skimming or profiting from segments which were very profitable for banks, like maybe cross-border payments, for example. And they are able to attract the best talent, which banks also have been had some trouble. Disadvantages. Well, they have an absence, at least the small ones, of an installed loyal customer base, limited access to soft information, although they are pretty good at transforming soft information into hard information, in codifying, and this presents a challenge in particular for small banks, so a competitive challenge. In principle, they have a lack of reputation and brand recognition, high cost of capital, and a small balance sheet. But in some cases, this is not a problem. For example, in the US, fintechs can give lots of mortgages because they securitize it. Basically, they sell them to the government-sponsored enterprises. Okay, so they unload it. So that's crucial. That's crucial. They don't need a big balance. Also, it's true that they lack regulatory and risk management experience and expertise that banks, even small banks, have. And in principle, they have no access to the central bank backstop without a banking license. Although this may change with stable coins if they are given access to central bank reserves. Okay, so then at least they would have these banks. Just a comment on the big tech platforms. They have all the advantages of the fintech with basically none of the drawbacks. Well, obviously, they have either access to the central bank and regulatory expertise, but they have superior data, network economies, impressive technology, artificial intelligence, etc., to treat this data, deep pockets, lobby power, etc. So these are the guys that potentially present a more severe disruption for the traditional banking business once they decide to get in, and they do decide to get in here and there in payments, credit, etc. Now the question is, to what extent does the emergence of fintech changes market structure and makes banking more contestable, more or less stable? And here there are countervailing effects. Definitely, fintech technology is very efficient. It promises to lower intermediation costs with new entrants. The incumbents have to really restructure. They have to invest in information technology. For example, most banks are still between the mainframe and the cloud, and they have trouble with that. They have trouble getting the appropriate human capital. They have an overextended branch network, and they have to restructure. So in sometimes they look like classical, retail or even steel industries, from before. But here, the importance of scale because of data is crucial, and so that's why fintech try to accumulate data so fast, and that's also why the big tech would have an advantage, and they do have an advantage when the dangers, in particular, when big tech get in, is that because of their gatekeeping power and the switching costs between platforms, they may be able to monopolize segments of the business, and in a sense, and let me just jump to a slide and then go back to some explanation. The future may look like a new platform-based oligopoly where most financial services providers, including, for example, small banks, may have to go through a platform to deliver services, which may be either controlled by a big tech or for a platform transforming company, okay, which this is what some large banks are trying to do. And then they have in a sense, their walled garden of customers. Okay. Obviously, the degree of competition in this world depends very much on the interoperability of platforms, and data portability and things like this. But this thinking a little bit more about the big techs, not so more small banks, although the small banks would be probably, their products would be commoditized, in a sense, and they will have to be distributed through this platform. Now, what can the incumbents, be it small or large banks and the fintechs do in terms of a strategy? Well, as usual, typically there are two types, generic types of strategies, one accommodating and the other fighting. Okay, so the incumbents, in particular the big ones, they can behave peacefully like a fat cat, and then try to preserve their base and maybe just get interchange fees from their from connection to their base, with high switching costs. The smaller ones, they may have a more difficult time. They may try to concentrate on relationship banking, although this may be a declining area. And the larger ones may try to fight, to prevent entry, to have this kind of top dog attitude, if you want. For example, by whatever they control, try to shut down or degrade access to the infrastructure. In any case, some of the banks are already launching their own fully online banks to compete. And they are trying, I'm not sure very successfully, not to contaminate their base, which is not online and that pays much higher fees. The fintech strategies are basically symmetric. They can either commit to remain small, maybe even not getting a banking license, which is also you enter into some regulatory trouble if you want, or cost better. And some, and this is what's happening in quite a few jurisdictions, they cater to unbanked segments of the population. Okay, so that's obviously is the best way for incumbents and for entrants. Also, they can form, and this is what is happening, partnerships, with established banks, be it small or large. Then the entry as a licensed digital bank, this is also happening, but typically less likely, given that once you are a deposit-taking institution, you have a much higher compliance cost, although some are taking this route. We'll see. I think this is still, it's trial and error. We'll see whether they try to consolidate to get more scale or sell to income. In any case, one of the, as I mentioned before, one of the major strategies is to harden soft information with technology. And so on this, they are making quite a bit of inroads, and this is very competitive vis-a-vis the small ones. So just since I'm out of time, let me say just a comment, a very quick comment on regulation. I think on regulation, the big question is whether, one big question at least, is whether regulation should aim at a level playing field or favor entrants in order to promote a competition. And obviously the entrants are typically these small entrants and fintech entrants. So here, this, so what I think is that the competitiveness of these entrants will depend very much, in fact, on the extent of the regulatory burden and guarantees schemes. For example, this example I put before on the US and mortgages, whether they meet a large balance sheet or not. Open banking, I think, has been, and Phil probably knows more than me about this, but in the UK, I think it's a success. It addresses what was kind of a market failure of low switching, market failure of not profiting from a technology because the incumbents, because it was not in the interest of the incumbents to introduce this technology in a sense, and that's what I think open banking has done. But there is an asymmetry in information sharing requirements, at least I am thinking now in the European frame, between the directive in which the banks have to open the data to fintechs or entrants if customers want, and the other way, and the flow of data mostly from big techs to banks, which is governed by GDPR, which are different. So now the Digital Market Act may balance it by requiring gatekeepers to follow a set of rules. Okay, so this I think may improve competition. That's my impression. Probably again, I would say the UK approach here, it's slightly better because it looks at the business model of the platforms, and it's not so much a catalog of cases. Okay. In any case, competition will depend on the data sharing, portability, platform interoperability, and this is what we should get right. Let me just jump two small comments on the stability, and I finish.
Can you finish in the next minute?
Yes. Even less. On stability, just two notes. One is that typical European principle seems to be that same risk, same rules, okay, for regulated activities. But this has a problem, which is entities are those that fail. And so therefore it's not the same one activity in a systemic institution than in a non-systemic institution. Okay, so this is something that I think is not fully worked out yet. And still we are thinking of how to deal with that. And second, on small banks, and given that is the topic also of this panel, I think we have to be careful with those small banks and stability, in particular when they have incentives to use correlated strategies, because then there may be too many to fail. So the example of the savings banks in Spain, all betting on mortgages, and construction, and building and apartments and so on, it's a case in point. Okay, so I think this is something to bear in mind that I'm sure the regulators have in mind. Thank you very much.
Okay, thanks so much, Xavier. And so now we're all back together, and let me maybe just pass this on and give both Phil and Anne a quick chance to respond to what the fintech challenge implies for supervision. I mean, does that reinforce the case for proportionality, or does it support, in your view, the underlying competition mandate that you both have in some form, in which case there would be a much more rapid consolidation and a more varied and diverse financial system, including the fintechs? And maybe you want to start?
Sure, happy to start on this one. I think a core challenge that we actually have is that a large number of the fintechs don't actually have licenses. And Javier mentioned that. We have a very, very limited number of fintechs actually having banking licenses and thus being regulated. In the Euro area, indeed, we are issuing licenses regularly also to fintech companies. They tend to have very long dated, business plans, and the break even usually takes very long. We also tend to monitor it. It's quite intense work, to be honest. I would say that I think the fact that we do not give leeway on reducing capital requirements or liquidity requirements, I mean, this is, I think, something I stated before, that holds true definitely also for those companies. I think, though, as I mentioned before, this proportionality aspect for SNCIs will benefit them, will make it easier for them to set up their operations, in my view. So I believe the framework is sufficiently proportionate to also welcome these fintechs. One more maybe topic and underlining a bit the issue of non-regulated fintechs. We have also currently done a study with all our national competent authorities on the use of deposit collection platforms. So Javier was focused a lot on the credit and the lending side. We looked more at the deposit collection platform side, where we saw that more than 100 banks that are under the supervision of the SSM, mostly less significant institutions, actually use these platforms very heavily to fund themselves. And this starts to take a quite large proportion. So I think these fintechs bring new risks, they bring new challenges to supervisors, and I think they also bring much more emphasis on supervisors collaborating, because a lot of these fintech business models are pretty international. So this is work we have on our radar. We have started with the national competent authorities that are largely supervising the banks using the platforms, but also the banks that are regulated fintechs. And it's a challenge. And in my view, I see no big reason to start saying, well, let's reduce the capital requirements or liquidity requirements. On the other hand, as I mentioned, providing less, say, administrative burden in terms of reporting, etc., and the concept of SNCI certainly makes sense, and in my view should work. But happy to listen also to
Okay.
Phil's view.
Okay, thanks, Phil. How does fintech shape the strong and simple strategy in the Bank of England?
Oh, so fintech is a gigantic question. I mean, the boundaries between fintech and banking are quite blurred. So you have fintechs who are fintechs in their own right. You have fintechs who work together with banks. You have banks which are quite fintech-like in their business model and approach. I mean, since the PRA was created, so 8 years ago, we've authorised something like 60 new banks. I don't know the proportion off the top of my head that are kind of fintech-like, but I would imagine it. But I can think of quite a few off the top of my head. So it is clearly part of the idea of promoting competition, allowing the conditions under which smaller banks can be created and grow. I mean, because of these blurred boundaries, one of the things we're very strong on is the thing that Xavier said is tough, which is same activity, same approach to regulation. I mean, I think that has to be your and supervision. That has to be your start point to try and achieve. We have frameworks, so we have frameworks that we can use, especially for banks which are fintech-like. So, you know, we have approaches to operational resilience, to risk management, to all the things that banks do that you can think about how to apply in the fintech world. In principle, you can do that, but it just needs a bit of working through. I guess the only other thing to note is that we are very, because it's a very big topic and I could talk for a long time, but I won't. We are very active in terms of thinking through issues on crypto and stable coins and central bank digital currencies in particular, which I know the ECB is too, where again the same risk, same prudential treatment, you know, is really important. So I'll stop there.
So yeah, we need to leave that for another seminar as we're nearly out of time. Now, if you all allow, we'll run over just 2 or 3 minutes, and I just wanted to pass on one question from the website to Nicholas. Is the current extent of proportionality appropriate given the need for consolidation, or does it create a disincentive as small banks will be discouraged by the greater regulatory and supervisory burden following a merger? You know, given the work you've done around the fragmentation of the euro area banking system in particular, what do you take from our paper? It's a big question to end on, but if you can just summarize your view in just a few sentences.
Exactly. As I said, our study doesn't really go into policy recommendations. We have a section at the end where we give our views on policy, and our take is that the current framework looks appropriate in relation to the EU objectives of financial stability, but also promoting a level playing field and competitive neutrality, if you will. The main point is really the fact that there aren't many small banks, and even if you compare with the UK, I think there are way fewer neobanks or new entrants into that space in the Eurozone as a whole than there has been in the UK with a number of attempts in the past few years. So again, I think the distinction between fintech in general and banking fintechs which seek a banking license, which is really our focus here, is essential. The former being a much wider category compared with the latter. One point I would mention, however, which is very topical in current conversations in Brussels, is Basel Compliance. I think one of the arguments that the EU has been putting forward for not being compliant, being materially non-compliant, to use the jargon, with the Basel standards is that because the EU does this good thing of applying the Basel standards to all banks, it can be given a little bit of slack in terms of the level of compliance. I don't think this argument is very compelling, and I think as the EU is currently revising its adoption of Basel standards, it would make plenty of sense to keep the general principle of applying the non-compliant version to all banks irrespective of size, but maybe make sure that the largest internationally active banks are fully compliant with the Basel framework, as is the case in other Basel jurisdictions.
Okay, great. Thanks so much. And so a quick concluding statement still from Xavier. So, given what you've heard in the last hour and, your many years of work on competition and financial stability, how do you compare sort of the work the UK, among others, but also many other central banks have done on fostering competition, including it in the mandate for the supervisor, and the euro area? Do you really think there's a sufficient degree of competition, and also is it institutionally well anchored and regulated to allow a more dynamic banking market in the euro area countries?
Well, it's different, the institutional framework, as we know, in the UK and, for example, and the euro area. The Prudential Regulatory Authority has a secondary mandate to foster competition, right? And the regulators in Europe, they do not have this mandate, so that's different. But we have a very strong, if you want, competition directorate in the European Union. It's one of the things that works in Europe. My impression is that still there are pockets where we need more competition in the European arena. And fundamentally, one thing that we need is a single digital market, I think. Mm-hmm. That this would, Europe, and this is a little bit broader comment, I think it's falling behind in the world, in particular the US and China, because it does not have a single digital market. And this would be, apart from being efficient, incentivate investment, it would also increase competition. And so that I could, easily find a financial product, in the euro area at least, in the euro area at least, a pension fund, that would not be, completely entangled in bureaucratic issues, many examples like this, this also depends on, yep, or is related to the capital market. But I would say that this would be a big jump, all we can do in this okay, direction. Okay. With
okay, thanks so much. So for all the regulators and supervisors, EU colleagues who hopefully listened, there is plenty of food for thought. And thank you all so much for joining. And I thought it was a really fascinating juxtaposition of the different experiences in the key jurisdictions. And I hope we can do more of that at Bruegel, to bring others and experiences also from outside Europe into a single discussion. There's much to learn from each other. Thanks again. Have a good rest of the week wherever you are, and we will put the material on the website, and hope we can share this also with others who didn't manage to listen just live now. Thanks so much, and all the best. Goodbye.
Thank you very much. Bye-bye.